Most people shopping for retirement income start with the wrong question. They ask, what annuity pays the most? That question can cost them hundreds of thousands of dollars over the course of retirement. Because the annuity with the highest advertised payout is not always the annuity that creates the most lifetime income for you. And that difference matters more than almost anything else when you're trying to make sure you never run out of money. I was recently talking with a man approaching retirement who had done everything a disciplined saver is supposed to do. He built a solid nest egg, avoided reckless decisions, and kept contributing through the downturns. He stayed the course. On paper, he looked fine, but underneath that confidence was a fear he couldn't shake. What if I retire and then longer than my money? That's the real question. Not just how to grow it or how to protect it, but how to convert what you've built into a reliable income that lasts as long as you do. And this is exactly where a lot of retirees get blindsided. They assume the highest paying annuity is simply the one with the best number on the brochure. It isn't. Sometimes the highest payout today comes with less flexibility. Sometimes it comes with less legacy value. Sometimes it only looks high because the fine print is doing the heavy lifting. And sometimes the better move, the one that actually wins over a 30-year retirement, is the annuity that creates more usable income over your lifetime, not just a bigger first impression. So today, I want to talk you through what smart retirees should be really asking, what really drives lifetime income payouts, where people get quietly fooled, and how to think about building your own private pension without gambling your life savings on the next market headline. Because once you understand this, you stop comparing annuities like products on a shelf, and you start evaluating them like income machines. And that changes everything. The first thing to understand is that there are two separate conversations people have when talking about annuities. One is accumulation, which is growing the money, and the other is income, which is converting the money into paychecks. A lot of people accidentally mix these together. They hear terms like cap rate, participation rate, roll-up, bonus, lifetime withdrawal percentage, and it starts to blur into one confusing number. But it isn't one number. Each metric does something different. One affects how your contract grows, another affects your future income base, another determines what you can withdraw for life. Confuse those, even slightly, and you end up choosing a contract that looks exciting on paper, but doesn't actually solve your retirement problem. And here's the mistake almost everyone makes. They chase the flashiest number, the highest bonus, the highest cap, the biggest payout rate on the sales illustration. But retirement income isn't won by chasing a single number. It's won by understanding the relationship between protection, growth potential, age, deferral period, rider design, and when you actually plan on turning income on. That's the game. Here's a simple example. Two annuities both sound attractive. One promises a stronger immediate payout, while the other offers more flexibility, stronger accumulation potential, or a better income benefit if you wait a few years before turning it on. Well, which one's better? Well, that depends entirely on your lifetime. If you need income now, then the answer is very different than if you're planning to retire in 3, 5, or maybe even 7 years. Which means the highest paying annuity for someone at 60 may be a terrible fit for someone at 70. It's the same product category, but a completely different outcome. And this is why so many retirees get bad advice. The conversation gets oversimplified, one product, one illustration, one payout line, then someone calls it the answer. But annuity planning should work more like engineering than marketing. You need the right design for the job, not the most impressive brochure. So what actually drives lifetime income? Let me walk you through the 4 real drivers, because once you see them clearly, the evaluation process becomes much more straightforward. Driver number 1 is your age. In general, the older you are when you start lifetime income, the higher your payout percentage tends to be. The insurance company expects to pay income for a few years, so the annual amount can be larger. But here's the nuance most people miss. Waiting longer isn't always better. A higher future payout rate also means you delayed years of income you could have already been receiving. There's always a trade-off between a larger future check and starting sooner. So driver number 2 is timing. It's now or later. Immediate income annuities can create strong current income right away. Deferred strategies And fixed index annuities with income riders often create more future income for retirees who still have a few years before they need the checks. This is why retirees who are still 2, 3, 5 years from retirement often have more options than they realize. Time is actually an asset in this equation. Driver number 3 is the contract structure. Some annuities are built for simplicity with clean, guaranteed payouts. Others are designed to give you principal protection, growth potential tied to an index, and an optional income rider layered on top. That matters because many retirees don't just want income. They also want protection from market losses, some opportunity for upside, and the confidence of knowing they're not exposed to a crash right before or during retirement. For the right person, that combination is genuinely powerful. Driver number 4, deferral strategy. This is where a lot of hidden value lives, and where a lot of people leave money on the table. Sometimes the highest paying annuity isn't the one that pays the most today, it's the one that allows the income benefit to build efficiently before you turn it on. A retiree who gives the contract a few years to mature can sometimes create substantially more lifetime income than someone who starts immediately without a plan. That's why one of the smartest questions you can ask isn't what pays the most now. It's what creates the most dependable income for the point in time I actually need it. That's the better question, and it leads to a better outcome. A lot of people compare annuities to traditional portfolios and assume the portfolio must win because it has more upside. On the surface, that sounds reasonable, but income planning isn't just about average returns. It's about what happens when real life shows up. What happens if the market drops 25% in the first 2 years of retirement? What happens if you need to keep withdrawing while your account value is down? What happens if inflation stays stubborn and the sequence of returns works against you? What happens if you live till age 93? That's where market-based withdrawal strategies can start to be fragile. Not always, but often enough that it's a risk worth seriously talking about. And this is why so many retirees become interested in guaranteed lifetime income in the first place, because they want relief. They want part of their retirement to become predictable. They want essential expenses covered no matter what happens with the market. They want income they can't outlive. And they want to stop feeling like every financial headline has the power to shake their plan. That emotional shift is bigger than most people realize. Because when a retiree has a personal pension style income in place, something changes. They panic less, they feel less pressure to time the market, they stop treating every downturn like a personal emergency, and they make better decisions with the rest of their money. That peace of mind has real financial value. Here's another place where retirees get burned. They focus entirely on the payout number and ignore what they're giving up to get it. A large payout figure can be seductive, but before you sign anything, there are important questions you have to ask. What happens to liquidity? What if you need to access the money unexpectedly? What does your beneficiary receive if you pass? Are there any fees? If so, how do they affect long-term performance? How is the income rider actually structured? Is it based on the contract value, the benefit base, or something else? Can the payout change over time? Are you actually comparing equivalent products? Because sometimes what looks like the highest income on one illustration becomes significantly less impressive the moment you understand the trade-offs behind it. This is exactly why cookie-cutter annuity recommendations are so dangerous. You don't need the highest paying annuity in America. You need the highest paying annuity for your retirement plan. There's a meaningful difference to that. When I sit down with someone to talk about retirement income, I don't start with products. I start with the pressure points. What are you most worried about? Running out of money? A market crash at the wrong time? Low returns from CDs or maybe bonds? Not having enough predictable income every single month? Once I understand the real problem, we can evaluate the right solution. And in many cases, fixed index annuities become part of the conversation because they offer something that retirees are actively looking for. Principal protection from market downturns, growth potential tied to positive index performance, tax-deferred accumulation, and the option to create guaranteed lifetime income. For the right retiree, that's a compelling middle ground between full market risk and low yield safe money options. But it has to be the right fit, not just a good sounding number. So here's the shift I'd encourage you to make right now. Stop asking which annuity pays the most and start asking which strategy gives me the strongest, safest, most sustainable income for the retirement I actually want. The one question that can save you from making a very expensive mistake. Because retirement isn't a spreadsheet exercise, it's your life. It's the difference between hoping your withdrawals hold up and knowing part of your income is contractually guaranteed. When that foundation is in place, retirement feels different. You sleep better, you worry less, you stop trying to time the market every cycle, you start focusing on the life your money is supposed to support. And that's the real objective. Not chasing the highest number or headline. It's about building an income that you can actually count on. If you're between 59 and a half and 79 with at least 250,000 in investable assets, this is exactly the kind of planning worth getting right the first time. Click the link in the description below to schedule a free retirement income strategy consultation right now. We'll look at your timeline, your income goals, your current holdings, and whether a guaranteed income strategy makes sense for your specific situation. There's no pressure, there's no generic recommendations. It's just a clear, honest conversation about what the right structure could look like for you. Because the people who win in retirement aren't usually the ones who found the highest number. They're the ones who built the strongest plan. Thanks for watching, and I'll see you in the next video.